What's up, guys? Welcome back to DCA. So in the past few videos, we've been talking about Bitcoin. We've been looking at the market dynamics of Bitcoin. Today, what we're going to do is shift our focus to Ethereum. So we're going to dive into a bunch of different metrics for Ethereum today to look at where we're sitting right now and where we may be going in the future. So we're going to do this in different ways. The first way we're going to do this is by looking at the DCA index risk model for Ethereum. So I just wanted to give an update on this. Now, if you don't know what this is, if you're new to the channel, this is a machine learning algorithm model that I've developed for looking at where you're sitting at in terms of your risk profile for the asset. So in other words, when you're up in scores of say 80 to 100, so the scale goes from 0 to 100. When you're sitting at these ranges from 80 to 100, typically these are going to be your high risk periods. In other words, if you own the asset, if you've been holding the asset, it's very advisable once you start to get into these ranges to start to take some profits. Simply for the fact that historically what we see when we get into the 80 to 90 and then especially the 90 to 100 range, the market typically pulls back at that point because these are going to represent your FOMO phases of the market. So we saw it back here in 2017, in the middle of 2017, where Ethereum went from around 400 all the way down to $145. And you'll notice that the risk metric was telling you this was an extraordinarily high risk period. Then we saw the same thing happen here in January of 2018. We got up to nearly the 90 range. So we were in the upper 80s. And of course, we all know what happened then. The market pulled back from around $1,400 all the way to a low of $77. Okay. And then in this cycle, we saw the same thing sort of play out, where in May, we did get into the 90 to 100 range. And then we all know what happened. Ethereum went from $4,000 all the way down here to around $1,700 in July. So this model basically just helps you to identify when the asset is significantly overbought and very likely to require a pullback. It's also useful for identifying when the asset is oversold. So when you start to get into these lower ranges, 0 to 10, 10 to 20, etc., these tend to be your best buying opportunities. So you'll notice that back here in November and December of 2018, we were significantly depressed. I mean, you could have bought Ethereum in 2018, early 2019, for $70 to $80, okay? And the risk metric was telling you that this is an excellent accumulation period. Then again at the COVID capitulation event, and then again here in the beginning of 2022, when our price went down for a second time down to $2,200, the risk model got all the way down into the 10 to 20 range. So these periods just represent good accumulation zones. So they're telling you basically that the market has overreacted to whatever events are playing out, and we're very likely going to see a reversal, or over the long term, this will be an excellent accumulation zone. But in particular, when you get down into these lowest ranges, these tend to be reversal zones. These tend to be market cycle bottoms, or at least local bottoms. Okay. So the next thing I just want to quickly point out is you can see that we're in this uptrend. We're still technically in an uptrend for Ethereum, a long-term uptrend. And we've basically been bouncing off of this upper trend line. Okay, so we started this during the breakout in January when Ethereum really broke out. And this is what we always say, the altcoins are going to move when Bitcoin really moves. So Bitcoin made its big move in January, and shortly thereafter, you started to see the altcoins break out. And since that time, you could say that Ethereum has been in nothing but an uptrend. So we've had large corrections. However, overall, we're in an accumulation zone until we otherwise break it to the downside. Now, what I find interesting about this accumulation zone, and I haven't even cherry picked these values here. I'm just going from close to close along the bottom end of the trend line. If you come here, so if you come to the settings and you just extend this left line, okay? So we extended the left line. Notice it extends right through the accumulation zone that we were in during the 2017 and then 2018 bull market until we eventually broke through to the downside in the middle of 2018. Now, what if we did the same thing with this upper end of the accumulation zone? And you'll see it's the same exact thing. It perfectly crosses right over the top of the peak of the 2018 cycle. So I just found this interesting that we've been traveling within this almost a bull market zone for, the last two cycles now. So it will be interesting to see if this trend continues on into the next cycle, because it's almost uncanny. If you look here, the bottom end of the trend line transects perfectly where you would have been during the bull market back in 2017. Notice that we just rode right along this line with only a single correction below it. But then all through the middle and end of 2017, we rode right along this line. We hit this peak in 2018, and then we came down to this trend line again, bounced off, and then eventually went down here until we rode along it for a few more months before breaking below. But I do think there's certainly something to say for longer term TA and its ability to show you long-term trends that are developing. So this is certainly something worth continuing to watch. Now, I do think if we were to break below this level, then we're very likely going to be in one of these longer-term downtrends where, based on whatever macroeconomic level events are going on, there may be a requirement for sort of a reset in the market, because there's been a lot of free money floating around, Fed printing, inflation, stimulus money, etc. So, there's a lot of reason to believe that things could turn nasty in the next, 12 to 16 to 24 months. And if that does happen, crypto, you have to remember, is a risk on asset. No matter what anyone says, it's a risk on asset. Okay, so the next thing I want to quickly talk about is the total market cap dominance for Ethereum. And you can see that ever since May, we've been bouncing between this resistance level up at 20% and this support level down at 17%. So we've just been repeatedly bounced off of the resistance up top at around 20% and then bouncing up off of the support level down here at 17% total market cap dominance. In fact, if you just look quickly, we've been bounced off of this resistance level 1, 2, 3, 4. We did break above for a short period of time and then fell back through. So 5. And now we're here for our 6th time. So this is just an intense level of resistance. It'll be interesting to see if for a 6th time, we yet again get rejected off of this resistance level and then have to go back down to this 17.5% support level as a total of the total crypto market cap. Okay, so the next thing we can quickly look at is the Ethereum to Bitcoin market cap valuations. Okay, so we've seen this place now where we're bouncing off of this lower portion of this this lower support level here and then getting bounced off and rejected off of this upper band. So you'll see that we've came down to this level now 1, 2, 3, 4, 5, and again 6 times and held this as support. But notice that this has been increasing throughout the length of 2021, and now it's continuing to increase in this upward trend into 2022. So we're sitting at a point now where Ethereum is at around 50% of the total market cap of Bitcoin. But you'll see that there's also a secondary resistance level within this larger trend, and that's right at this around 48% level. So we are sitting directly at a significant resistance zone, anywhere from 48 to 49% of the total Bitcoin valuation. And so, based on what we've seen, the total crypto market cap level that we're at a major resistance zone, as well as with relation to the valuation of Bitcoin. So we're sitting right on top of 2 major resistance zones. Resistance zones represent an area where you can very likely get rejected, but they also represent an opportunity, because in general, if you can break above one of these resistance zones, if you can break above that level and get into this next zone, that's how you start to move into completely new levels. So, what we're saying is it could very likely result in the price of Ethereum going down in the short term. But ultimately, if Ethereum wants to become what a lot of people suspect that it will, it's going to need to break above this resistance level. Okay, so, we're forming this ascending wedge, and obviously that's a very bullish sign. So eventually, if this trend continues, we're going to expect to see that it will break above. And typically when an asset breaks above a resistance level, especially one that's been forming for going on a year, it does so in very dramatic fashion. So I don't think this will be just a slowly moving over this trend line thing. I mean, notice when we first tried to break above this, we went from 47% up to around 53% in a single week. So that's the type of dramatic move that these assets will make when they officially break above. And I suspect this will happen again when we're able to get above this level, if we're able to get above this 48% level. So Bitcoin's always going to have a lot of the institutional type investment, but a lot of this money is now moving from Bitcoin, or perhaps not from Bitcoin, but in addition to going only into Bitcoin, it's starting to come into the layer ones like Ethereum now as well. Now, the next thing I want to show you is this, and I think this is important in terms of what's happening right now. And this sort of speaks to whether we're going to be able to break above these resistance levels. And I'm going to kind of show you why I think that's going to be difficult. So we're looking at the active addresses for the cryptocurrency market. And these are specifically the active addresses for Bitcoin on top and Ethereum on the bottom. So you'll see that Bitcoin has around double the number of active addresses that Ethereum has. And that's not surprising. It's kind of always been like that. There have been times when Ethereum's got much closer, but overall, we see that the number of active addresses for Bitcoin is sort of double that of Ethereum. Now, notice back in 2018, this sort of demonstrates to you why Ethereum went on that insane run where, just going up over 100,000% in that short amount of time. And look at the number of active addresses. It went from 16K all the way up to 650K. Now, notice where we're sitting at now. We're sitting at around 500K. But our peak that occurred back here in May, we were sitting right at around 750,000. So we've actually seen, if we just measure this move here, and we'll do this, you can see that we are down around 35% for Ethereum, and probably something very similar for Bitcoin. So Bitcoin has fallen by approximately 28%. So if you think about it, for Ethereum, what drives the demand for the Ethereum token? It's a use case token. Whereas Bitcoin is more of a buy and hold token. It's a store of value. So the primary use, other than speculative investment for Ethereum, is using it to pay transaction fees. So if you have, if we've lost nearly 40% of the users of the network, naturally it's going to be very difficult to get the price to sort of spike up to these new levels, to new all-time high levels. Now, that doesn't mean it can't happen, because obviously institutional type investors, speculative investors, etc., they can come in, especially if they're large enough players, they can come in and buy the asset, pull it off exchanges, and sort of, drive the price up that way. But typically those type of investments are being made over the counter. So they create a longer term supply shock issue. This is the 9-day moving average, just to clean up the data, because if we don't clean up the data, it looks like that. So it's a mess. So this is the 9-day moving average versus the 200-day moving average of the active addresses. Notice that in 2017 into 2018, we were sitting well above our 200-day moving average for active addresses. So the 9-day in pink was well above the 200-day in yellow. When did the market turn bullish? It's when we fell below our 200-day moving average, because remember, Ethereum's demand in terms of its pure use case, not its speculative demand, is driven by people using it. And if you have less active addresses, then you're naturally going to have less use and therefore less demand for Ethereum, other than speculative investment. So we see that after this move in May, we fell below this 200-day moving average, and we've been oscillating above and below it ever since. And now we're sitting significantly below it. So you can see that we're sitting right at around 50,000 addresses under our 200-day moving average. So ultimately, what is that telling us? That's telling us that during these periods, it's just simply difficult for the price to just shoot up to these levels that people talk about. People talk about the fact that we're, there's no chance of, the market correcting significantly in 2022, et cetera. And I think these people are just ignoring a lot of just the data, because that's what we do on this channel. We look at the data. I don't care about my opinions. My opinions don't matter. I'm accumulating the asset right now because I believe in its long-term potential. But in terms of its short-term potential, I find it very difficult to believe that we are going to be sitting at 5 or 6K somehow just within the next few months, or even based on everything we're seeing right now, even within 2022. However, this is the log regression curve for Ethereum. And I want to show you what this suggests, that if we assume that another market cycle, a bull market, occurred in 2025, and that would be based off nothing other than the 4-year cycle theory, which I don't subscribe to, but I do think, the way that bull markets go, I think, we could potentially see a year or two of correction and then into some sort of bull run, maybe in 2024 or even 2026. Doesn't matter. The point remains. So these are the log regression curves. And what these do, it basically shows us the growth trend over time of Ethereum. So we have this upper band of the log regression curve. And this suggests that if, we just waited until 2025, that the upper band during a bull market would be somewhere at around $12,000 to $13,000. Now, what we've seen, however, if we come back here and look at log curves for Bitcoin, what we see is that you never expect the log curve that you're on to again present itself in the next market cycle. So we've seen that in each cycle that Bitcoin has moved down 2 log curves. So we were along this pink line here and we came down 1, 2. And then we were along this yellow line here, and then we came down 1, 2. And so, if we assume that this happens for Ethereum, that we will also drop down off of a log curve, which we did if you only drew a log curve through the top of the first cycle and then tracked where that would go. In relation to where we were here, we were down 2 curves. I don't have that demonstrated here, but it plays out just like we would expect. So what I've done is I've used a decay factor, which would put us down 2 log regression curves in order to estimate where we may hit in a coming cycle if it were to occur in 2025. And you can see that that would put us somewhere between 7,200 to this upper end of this circle here, 7,200 up to around $10,000. If we were to drop down 2 log regression curves. Now, if we didn't, then you would be expecting something on the order of 14 up to around $15,000 if it were to extend into the end of 2025. So I do think, when you look at these log regression curves, especially for the larger assets, they tend to be very consistent over time. And I know a lot of people are uncomfortable with these, or, don't believe that they hold any ground. But, when we look at the log curves for Bitcoin, it's held perfectly throughout each of the market cycles. You can see that we've been between this lower band in 1, 2, and now a 3rd cycle. Okay. And then within this upper band throughout every single cycle of Bitcoin's history now. So this shows us that, we are sitting now below this expected location of the upper band in the next cycle. All right. So I think that this is, if I had to just put my money down and guess where Ethereum is going to be in 2025, it would be based off of something like this. And I do think that somewhere between 7,000 up to around $10,000 is a fair estimate. I know a lot of people think that this is way undervalued and a lot of people think that this is way overvalued. I'm probably the only person in America who thinks 7,000 to 10,000 is where it's going to end up. I think everyone else is going to say something like 30,000 or, zero. So this is probably the most conservative estimate out there. This is my complete breakdown of Ethereum, what I'm looking at both in the longer term timeframes, looking to the next market cycle, as well as the shorter term timeframes where we're sitting right now. So just to recap, we're at a lot of resistance levels. We're at a major Ethereum dominance resistance level. We're sitting right at a major resistance level against the Bitcoin valuation. So I think there's going to be some significant pressure coming up against us, not to mention the fact that the active users is significantly depressed right now. And remember, it's going to be, just quite frankly, it's going to be difficult to go and set new all-time highs when the number of people using the token actively is down from where we were. So we're down, remember, around 35% right now. So that's going to be it for this one, guys. If you guys like this type of content, hit like and subscribe. And until next time, as usual, see you.